It's a myth that advisors using ESG indices have to give up returns in order to make an impact. ETF asset managers and portfolio managers and financial advisor firms armed with this knowledge are power users of ESG indexing. As modern ESG strategies like the S&P 500 ESG Index arrive, advisors and asset managers are increasingly asking, how does ESG work in purpose-built portfolios? Hello, I'm Paul Murdoch of S&P Dow Jones Indices. Joining me to explore this question and to discuss ESG implementation are Aaron Brockman, Managing Director at Steward Partners Global Advisory, Victor Orozco, Partner at the Wealth Consulting Group, and Mona Naqvi, Senior Director of ESG Indices at S&P DJI. Hello, and thanks for joining us for a practical look at how ESG implementation works.
Thanks for having us.
Honored to be here. Thank you.
Thank you.
Thanks, Paul.
So Victor and Aaron, let's go ahead and start with you. You're already using S&P 500 for US equity exposure. So then how do you plan to use S&P 500 ESG?
Sure. So, the S&P 500 is kind of the iconic index that many investors look at when they think about their portfolio performance and kind of a comparison. And so we've worked with ESG investments for a number of years, and it's our goal. We're developing a social impact scorecard to actually show investors that you can kind of have your cake and eat it too, where you can achieve similar returns to the benchmarks that you're trying to track, but also have a material impact on society that you can measure and understand in a way that makes sense.
Thanks, Aaron. And Victor?
Yes, so at the Wealth Consulting Group, we have two versions of what we call our high impact portfolios that take account of ESG integration. One primarily uses actively based allocations, and the other is exclusively ETF. So we see S&P 500 ESG really being that large cap core holding for our ETF allocations.
Thanks, Victor.
You're welcome.
So Mona, you've been out on the road with institutional investors in Europe and more recently with financial advisors in the US. I'm curious, what are you hearing in terms, specifically looking at the financial advisors, of how they plan to use this new ESG tool?
Yes, Paul, well, it's clear to me from speaking with the market that ESG simply means different things to different players. And it really comes down to one's level of conviction in sustainable investing to determine how willing one is to deviate from their policy benchmark. But what's attractive about this particular tool is that it achieves a significant boost in overall ESG performance, so accounting for material issues like climate change, gender equality, human rights, while at the same time achieving a similar risk and return profile to the S&P 500 with a very low level of tracking error. So those conversations about impact versus tracking error are less of an impediment to core implementation.
And I imagine that's resonating with both that financial advisor and institutional investor audience. Yes,
precisely. For both sides of the spectrum, I think most market participants simply want to be responsible fiduciaries and provide the best return that they possibly can for their investors. But at the same time, we are seeing this growing awareness and interest in sustainability performance. And so being able to marry the two without necessarily having to have a performance trade-off is very compelling.
Great, thanks, Mona. And Victor, in terms of the conversations that you're having with your clients about ESG, what are you hearing about what they are looking for, and how are some of these new ESG tools helping address those wants and needs?
Right, so they're asking for many different things. However, they're not leading with that, right? It's our job as the advisory community, which I feel we don't do the best of jobs, is to really ask them those type of questions. And in that conversation, you determine what's important to them, rather it be environmental resources, it'd be LGBTQ worksite benefits, how diverse are their boards and essentially their company. And those are some issues that come out in those conversations, or they just really appreciate being involved with companies that have better sustainability practices that are material to them compared to their peer group. So that's one thing that we're discovering in the conversation. So the ways we're doing that is key is, one, have the conversation. Let them know it's accessible and available to the community. Two is really educating the group on the differences between socially responsible investing, which has been exclusionary in nature, vastly different than ESG integration. It's a little bit more inclusionary. So that's key to set up the proper expectations with the consumer there. And then lastly, having different portfolio options for them to align their values with and provide those solutions to. Because like Mona said, there's a lot of different values and you can't have just one portfolio to meet all those.
Great, thanks, Victor.
You're welcome.
So Aaron, in a previous call, you shared that clients are at a turning point when it comes to ESG use. How then are your conversations shaping up, given that we're in this turning point?
Yeah, it's a good question. So over the last several years, we've really tried to take away, I think that our industry doesn't do a great job of explaining things in a way that most people can actually understand. There's a lot of acronyms, SDG, ESG, a lot of fancy terms, standard deviation, alpha and beta. And what we're trying to do with kind of our social impact scorecard is take away a lot of the noise and a lot of the jargon and allow both individual investors and institutions to understand what's in their portfolio and the social impact that's taking place. And so as we reached out to our existing clients for feedback on this, a lot of people started reaching out to us to provide additional feedback on the tool or the scorecard, and over $10 billion of money is now giving us active feedback on the social impact scorecard and how we can improve it in the future. And so it's certainly exceeded our expectations and pretty exciting.
So in terms of those institutional investors who are reaching out to have those conversations with you, there's that $10 billion in backing that's shown, hey, this is important to us.
We have an interest in this. We have an interest in better understanding the impact that our money can have on society. And we want to be able to report this to our stakeholders in a way that they can actually understand without needing an advanced degree in mathematics to do it.
Great, thanks, Aaron. And Mona, to that point, the methodology of the S&P 500 ESG Index is really clear, simple, and transparent. But some of the feedback we've been getting is maybe clarification on what isn't in the index. Can you walk us through some of the exclusions that go into the methodology?
Yes, absolutely. So the first thing to say is that it's based on the S&P 500. But then there are certain exclusions that are made based on our ESG index methodology, and then there are other types of companies that are simply not selected. So the methodology first excludes companies involved in the production of tobacco, controversial weapons, and the bottom 25% of globally ESG ranked companies within global industry groups using our S&P DJI ESG scores. It also excludes companies that are performing poorly on the principles of the UN Global Compact. So this is a sort of catch-all measure for removing the worst offenders in terms of human rights abuses, labor issues, the environment, and corruption. But then what we're left with is an eligible universe. So after having made those exclusions, we then select the companies that go into the ESG index by targeting the top 75% of market cap within index industry groups, again ranked by these S&P DJI ESG scores. And so for the 316 or so companies that remained as of the last rebalance, the index weights from the 500 get redistributed amongst those. And so what we end up with is an index that looks and feels very much like the 500 because the industry weights have stayed the same, but whilst simultaneously achieving a significant boost in ESG.
Great. So it's important to understand the exclusions, but the power of this index is also the data driving it and what remains in the index itself.
Yes, precisely. So the underlying data is incredibly robust, and it offers us a deeper lens on how well companies are managing the sustainability issues that they're exposed to. But the key thing to note is that not all ESG issues matter for all industries, and we take an industry-specific lens on the problem. So it's not just simply saying carbon is bad, gender equality is good, apply that equally across the board. It's understanding those instances where these particular issues are a determinant of the future success of a particular industry and companies' business models. So I like the example of cybersecurity being very relevant for a financial services firm or a technology company, whereas in the mining industry, that's probably a lot less relevant. So it's taking a very industry-specific lens, as I said, and utilizing over 2 decades of real investment performance information from our partners, Robeco Sam, to hone in on the most financially material issues within specific industries.
Great. Well, thank you, Mona, Victor, and Aaron, for your discussions on S&P 500 ESG as a new tool.
Thanks for having us. Appreciate it.
Pleasure to be here. Thank you.
Thank you, Paul.
Thanks to our guests for sharing their practices for ESG implementation. If you'd like to learn more about how ESG indices work for financial advisors, please visit our website, spdji.com, to read our latest research, analysis, and to learn more about what's inside the S&P 500 ESG Index. Thanks and have a great day.